apologize because I am 100% positive that at some point during this class, I will forget whether I was talking to y'all or my principal's classes because we are overlapping material. So 1 week I'll cover it with you guys and the next week with principals, and then it kind of switched back timing-wise to the opposite where you guys were in front of them. So I'm all twisted up as far as who I've been talking to about what, and for whatever reason, dealing with current liabilities and long-term liabilities, there's not a whole lot more depth that intermediate goes into beyond what you learned in principal. So this should mostly be a review of that, obviously. But anyway, I apologize if I have a hard time remembering if I told you guys or the other class something. Okay. So y'all should know what current liabilities are, well, what liabilities in general are, obviously. But as far as what makes them current versus long-term, we've got the 1 year threshold that pretty much in the accounting world, anything under 1 year with respect to anything is considered current, and anything over 1 year is considered long-term. So if you have assets that you're likely to turn into cash within a year, that would be current. And then obviously if you have liabilities or something that you owe to someone else, that you're going to have to pay them within the next coming year, then that would be what distinguishes a current liability. And this particular slide is more just talking about the definition of a liability in general, textbook definition. Obviously that kind of overcomplicates it more than it needs to be, since you all know a liability just means you owe somebody something, right? Okay, so now the last one was, in general, what is a liability? Now, what is a current liability? And the operating definition, like I said, is basically just within 1 year. You have to pay anything on this liability within a year. Okay, so what that means is you can have some liabilities, obviously, where you're going to pay some of it within the next year, and then a lot more of it or any of it beyond that 1 year threshold. You would have liabilities that have components of both current and long-term pieces. But the reason that we, on the liability side, distinguish between current and long-term is because the fact that we're going to have to pay for these out of our current assets, which generally means we're going to have to pay for these out of cash or something that I know is going to turn into cash soon. If you think about the lifespan of a company and what typically makes a company go bankrupt, or at least what makes a company go bankrupt that could have otherwise been a successful company. In other words, it's not like they made a product that sucked or that there just was no market for it or anything like that. But if companies that end up going out of business that are just poorly run or poorly managed usually end up doing that because of cash flow issues. So, you know, balance sheet assets versus liabilities, maybe their net worth isn't all that bad, or they're not in too bad of debt or whatever, but if for whatever reason, if most of their assets are long-term and they can't liquidate them in a timely fashion and they have these liabilities building up, they may end up going under because they cannot pay their debts in a timely fashion, even though otherwise, if they've managed cash better, they may have been very successful into the future. So obviously, since this is a financial accounting class, we're looking from the perspective typically of an investor. at the very least, someone external to the company, from their perspective, current liabilities are very important because that is a metric that you can look at to judge, at least in the short term, the viability of the company, the likelihood that they're going to last into the future. And obviously that is going to be more and more important the younger or the less established of a company that you're talking or looking at. Anyway, because of that, from the company's perspective, typically a company wants as many of their debts to be listed as long-term as is possible because they know that that makes them a more favorable-looking investment opportunity because it gives people some measure of security that they're going to be around into the future for the investment to pay off. Typical examples of short-term or current liabilities right here. Obviously, the most common that we will see throughout any business is going to be accounts payable because those are so informal, and basically anything that is invoiced to you shows up in accounts payable. So unless you have formalized some type of IOU document, loan documentation, if you haven't done some formal agreement, pretty much any liability that's a current liability will show up in accounts payable. And then all of the rest of these typically arise out of some type of extra contract that you've signed and details the debt. Obviously, income tax just comes up from you benefiting from the country that you're in. So liabilities, typically we say most items on the balance sheet should be recorded at their present value because we don't want to skew assets or liabilities that are not going to be liquidated until very far into the future. We don't want the time value of money to go unnoticed or unrecorded in our financial statements. So any future revenues that we're recording are typically discounted by the time value of money, but on the plus side, so are liabilities, with the exception of those that come due within a year. So since we're talking this chapter on current liabilities, all of the liabilities that we talk about within that category will all just be listed on the balance sheet at whatever it is it's going to cost us to pay. The idea behind that is just that if this is something that's due and we're paying and it's turning over quickly enough that it's considered a current liability, the time value of money should be fairly negligible. So we don't expect wild fluctuations in the short term as far as the value of money goes. So we consider it a worthwhile efficiency to just talk about these types of liabilities at their current or their cost value, basically. We already talked about why investor might care about whether something's a current or a long-term liability. That's more information, I guess, on that. You guys know when liabilities occur. Anytime a business needs or out of convenience receives something of value for which they haven't paid yet, that incurs some type of liability. Okay? And like I said, that could be out of necessity because the company couldn't otherwise afford to do it, or it could just be out of efficiency where it doesn't make sense for it's quicker if you can order something and the company can just ship it to you with an invoice than it is for you, or at least in the past, than it was for you to write a check, drop that in the mail, have that get there, then have them deposit that, then fill the order. So a lot of this system that we have now, where most things are done via invoice and then paid later, which gives rise to current liabilities. Most of that came out of that time delay that you used to see. Nowadays, obviously, with money being basically electronic, it really wouldn't be all that hard to just, push a button here and there and have the money transferred. More and more throughout the world, I mean, every day, I think this is almost exponential growth of the paper system being completely obsolete and everything being done electronically. So, obviously as that gets more and more automated and when transactions can occur that quickly, what you're probably going to see on accounting financial statements is less and less current liabilities because you're going to virtually eliminate the efficiency need for current liability, and then basically they would only exist if there's an actual monetary need to borrow. So trade accounts, trade notes, that's where I'm talking about efficiency. Bank loans, where you have either a formal loan or a line of credit from a bank, that's going to be more from a necessity standpoint where, hey, we just want to make sure that we have enough cash flow for whatever reason. And if we don't, that we can go and have access to cash if necessary. Commercial paper essentially is a formal loan that a company may use to borrow money. And it's basically a loan combined with security that is, say, a company says, hey, I want you to loan me $25,000 and I'll pay you back and I'm good for it and all that. Plus, I'm going to go open a line of credit with this bank for $25,000 and not spend anything out of that. So you know that even if things get rough, I can go get that money out and use that to pay you back. That's essentially how commercial paper works. And what it does is it allows a corporation to borrow at a substantially reduced cost because they may pay a slight premium to the bank to have a line of credit open there. But the guarantee that or the surety that grants the lender that the money will be there no matter what allows the lender to reduce the rate that it would charge to loan the money. Typically, you see as risk is reduced, the amount of interest rate that's demanded to borrow the money is also reduced as well. Let's see here. We talked about, y'all should be really familiar with accounts payable at this point. Want to make sure that, all of that is stuff you guys should be familiar with. We'll talk a little bit about non-interest bearing notes here. I'll quickly go through. You guys should be familiar with what a note payable is, or at least you should remember that they exist. And that basically a note payable typically arises out of an account payable that is formalized, but basically it's just a more formal agreement to pay or to have an account payable set up. So if a company is not comfortable just invoicing you and having you pay them later, or if in the past you've been late on payments or whatever the case may be, they may want a little bit more security, and so they may ask you, okay, we want you to sign this formal agreement that states these terms that says, if you don't pay us within 10 days, you owe us, a late fee of this amount and this amount. Just makes it easier on the company who is lending the money, or the entity that's lending the money, to have legal recourse if the payment is defaulted or if the payment's not made. So it's just a little bit more formal. Yeah, I don't know what the ice cream cone graphic there is supposed to tell you, really. Line of credit is similar to a note payable with a bank in that it's a contract. You sign it with the bank. The difference is, instead of approving you for a certain amount and giving you all that money right then and charging you interest on the whole thing, you negotiate for a certain line of credit, say $1 million with the bank, and the bank basically almost functions like a credit card, where you have this line of credit that you can charge against, and you can basically use that to pay for whatever you need to. And then typically the interest rate is slightly higher on a line of credit, but you're only paying interest on the money that you actually needed, because you're not paying interest unless you borrowed or unless you actually physically went out and took money out of that line of credit. So, basically just provides a little bit different, or a little bit, I don't want to say necessarily more flexibility. It's just a different way of borrowing. If you know specifically what you need, it's cheaper to do a note payable. If you're not sure, and you just know maybe you're going to need money in the future, the flexibility is more with the credit, or the line of credit, rather. You guys don't have to worry too much about committed versus non-committed. That's more of an issue if you're on the bank side of things. Let's see. You know what interest is, I hope. Calculating interest should be old hat by now, but again, I will remind you that the most common mistake in accounting classes and for the CPA exam in anything that has to do with interest rate calculations is the fact that they give you an annual rate, and then, especially on the CPA exam, I can pretty much guarantee you anything that has interest rate, they'll give you an annual rate, and you will never have a period in terms of full years. Okay, so it will divide it up and say the annual rate is 8%, but we only care about interest for 6 months of the year, 4 months of the year, whatever the case may be. So I guess what I'm saying there is, whenever you see an interest rate problem, please make sure that you remember to check and see what time frame we're talking about, and make sure whatever interest rate you're using to calculate it, you have already allowed for whether that is an annual rate or whether that has already been broken into the periods that the interest will actually be paid. Okay, so just the accounting for when the note's issued. You get $700,000 from the bank. The bank gets essentially an IOU from you that you have recorded as a credit in a liability account, notes payable, and that's what it looks like when it's issued. Remember, as the day that a liability is issued that is interest-bearing, or that earns interest, or that you have to pay interest on, I should say, no interest has accumulated, right? Interest is a factor of time. The amount of interest that you pay is a factor of time. So if no time has passed, then the day that this is done, no interest has accumulated, and that's the only liability that you have. Then as time passes, in this case, we have a 6-month period that passes, and every 6 months we're supposed to pay this interest expense. So I'm calculating it. Again, pay attention to the fact that this is only half a year. So instead of using a full 12% times 700,000, you're really using 6%. They have it written out according to their formula, but in actuality, obviously what you're doing is taking the annual rate and dividing it by the amount of time, the portion of 1 year, I should say, that is elapsed. So you would have, in this case, the full note payable is due at the end of 6 months. So the entire maturity length of this instrument is only 6 months, and we're only making one interest payment for a 6-month period. Okay, and obviously we paid back the principal plus the $42,000 interest there. May 1st Affiliated Technologies Incorporated, consumer electronics firm, so similar facts here. Difference being that we have a non-interest-bearing note, which is kind of a misnomer because it doesn't mean that you're not paying interest. It just means that the interest that you're paying shows up in a different way. Okay, so in this case, we have basically $658,000 being paid to us, as that's the amount that we're borrowing, and we're paying back $700,000. So we're paying back $42,000 more when this is all said and done at the end of 6 months than the amount that we were loaned. So again, you can see there that you are paying for the loan. You're paying $42,000. It's just being called a discount there instead of being called interest. Okay, so at the end of that time period, we get rid of the discount and just turn it in to interest expense. Okay, you remember, actually, I'm sorry, I almost did it there. I talked about this in my other class this morning. Basically, well, I won't get into that until we talk about long-term liabilities. You will see this again when we talk about long-term liabilities, this whole idea of discount or premium on these notes. And basically, whenever you see the word discount or premium, they all, I guess what I'm trying to say is they all function in a similar way. Okay? So you will see this again in the way this functions when we talk about long-term liabilities. But in this case, at the outset, we didn't call it interest expense because, why? Because time had not passed. Okay, remember, for interest to be earned, the time has to pass. So in this case, we don't actually call it interest on our financial statements until the time has passed, and then we change the discount to interest expense. So at that point, once that journal entry is done, there basically really wouldn't be a difference in how the accounts looked on your financial statements, whether you did a non-interest-bearing note like this or whether you did it as an interest-bearing note. Because either way, you're going to record an interest expense. In this case, you had a discount, but you canceled that completely out. And that's really the only difference between doing it as non-interest-bearing versus interest-bearing. Effective rate versus actual annualized interest rate. Basically, effective rate just means divide the amount of interest you paid by the amount that you borrowed. And that tells you what your interest rate was overall. Not looking at time as a factor then. Then if you take that and basically turn that into a year's worth of time, that gives you your annualized interest rate. In this case, all you had to do was double it because it was just a 6-month time period. When we talk about secured loans, there's really not a whole lot you have to do with a secured loan other than just know what it is. Secured loan just means excuse me, that you are pledging some type of asset that you have as collateral, which again really doesn't do a whole lot other than give the lender a little bit more of an easy time collecting on this debt if things go badly. Okay? So often this happens with accounts receivable because next to cash, accounts receivable is generally considered one of, if not the most liquid asset that you could have. So a bank may say, hey, we see on your books you have all these accounts receivable. We'll go ahead and give you this loan, but we want effectively a lien on those accounts receivable where we know if you don't pay us, we can go in and assume ownership of those and collect on those ourselves. Okay? That's pledging. Factoring is where you just go out and instead of pledging that to the bank, you say, I don't want a loan. I'm going to sell you my accounts receivable. You can collect on those. You give me the money now, obviously less money than what's possible to collect because there's some risk there. But the bank or whatever entity would give you the money then. They would buy the accounts receivable and basically they would then own the debt. Do we have any questions on that? We talked about commercial paper being backed by a line of credit. When we talked about, in principles, when you talked about adjusting entries, accrued liabilities was one of the categories of adjusting entry that we talked about, and that is when basically we owe money that we have not yet paid. Okay. Common examples listed there. Do a quick walkthrough of one here. On May 1st, Affiliated Technologies, again, we got this $700,000 cash that is borrowed on a non-committed short-term line of credit. Issued a 6-month, 12% promissory note, interest payable at maturity. Affiliated Technologies' fiscal period ends 2 months after the 6-month note is issued. So basically what they're trying to say here is 2 months of interest has accrued. As time passes, that's what triggers us owing money. So when we issue the note, again, as of that instant, no time has passed, so the only money that we owe is the principal. As time passes, we owe money. We don't necessarily care that as every second passes we record that transaction, but we do want to make sure that whenever we do financial statements, it's accurate up to the moment in time where we say our financial statements go up to. So that's why we do the adjusting entry, and that's what it looks like here. Okay, 2 months have passed, so we want to capture 2 months worth of interest expense that we're going to have to pay. You recognize that expense immediately so that it goes on that year's or that fiscal period's net income, but we don't actually pay it yet, okay? Because we already have a schedule of when this is going to be paid, and this is actually should be anyway, this goes into interest payable. Then at the conclusion of the 6 months, when we would normally pay this interest, we will pay the full amount of interest. Part of it will come out of interest payable, and then the other part will be debited against interest expense. I think the next slide looks at that. Okay? So when we go to pay off the overall debt, full amount we pay is the principal plus the 6 months worth of interest. Okay, so that's $42,000 of interest. Part of it we already recognized as an expense when we did the adjusting entry, and we stored that as a liability. The other part we hadn't recognized as an expense yet, but we do it now. When you combine those two, that's the full interest payment. Okay, another category, and we won't talk much about this, but another category of current liability that's common and pretty much every company has are these salaries payable, commissions payable, bonuses payable, etc. Again, this is another category of current liability that I actually believe will be eliminated, probably be totally obsolete in the next 10 or 15 years. Because this has come about because of the delay that used to happen between writing paper checks out and stuff having to be mailed and sent and all that stuff. So there was often a very long time period, or at least there had to be some time period between like for instance, the hours that you worked and the paycheck you got for those hours. Okay? Typically, even now, here, well, it's a little different for me because I'm salaried, but even in other jobs that I've had in the past, before I worked here, you would typically be paid, like a week or maybe 2 weeks after the end of a pay period. So maybe the pay period ends on a Friday, and you get paid for that 2-week increment between the last pay period and this pay period, but your check wouldn't come to you until the following Friday. So until those checks are cut, that's a liability to the company because you've worked the hours. They still have the money that they owe you, so it's a liability. In this day and age, really, those shouldn't happen as automated as we are because the transaction speed is instantaneous for all of this stuff. So especially if you're automated where you're tracking time and having all of these withdrawals and deductions coming out automatically, really, as soon as time is recorded, you should have the capability of instantly shooting money into someone's account for payment. So I actually believe that'll go away. At least we are already technologically capable of making these types of short-term liabilities or current liabilities go away. But we also have vacations, sick days, and other future absences. Obviously, those are things that we don't really know. They're kind of contingent. You don't know when someone's going to take off vacation days, use up sick days. But these are days that we're losing productivity and we're still paying these individuals. So these are also considered liabilities. So again, we're not going to spend a lot of time on how you would calculate. Basically, usually some type of actuary, or you'll have actuarial data at least, and you'll use that to calculate the amount of liability that you should record for vacations, sick days, etc. But for the purposes of our discussion, just know that there will be a component typically of these that falls under current liabilities, and there will be a component of these that falls under longer-term liabilities because of the nature of the liability itself. Don't worry about the conditions here because, like I said, we're not going to spend a lot of time on that, and I don't remember ever seeing any of that tested on the CPA. Annual bonuses have existed forever, but they've become more and more prevalent over the last 10 or 15 years. especially when you're talking about like CEO level employees, because the Securities and Exchange Commission has limited the amount of compensation you're allowed to pay a CEO and have it be deductible. Okay, so currently a company is only allowed to deduct up to the first $1 million of compensation that they pay their chief executive. That's a big deal if you have if you're competing for executive talent that expects like $20 million a year, $30 million a year. If those are the types of people you're trying to hire, you don't want to have to pay $29 million worth of expense that you don't get to deduct. That's a huge amount. If your tax rate's even 25%, you're talking about almost $10 million worth of lost deduction there. Okay, so instead of taking that huge hit, what a company will often do is tie compensation to performance and say, okay, we're going to pay $1 million no matter what, and then if you meet these benchmark performance standards, then we'll pay you X amount of dollars or stock options or whatever as a year-end bonus. And obviously, if that's part of the contract and the company hits those benchmarks, the company is then obligated to pay the executive that compensation. So again, for these types of bonuses, especially when they're tied to performance, you have that kind of flavor of it being a contingent liability because you're not sure necessarily that they're going to meet these types of standards. Okay, but again, that's the whole tax deductibility of executive compensation that came out of Sarbanes-Oxley is kind of what has driven this push to more and more, especially at the executive level, bonus compensation. Another type of adjusting entry that you talked about in principles that we're bringing back up here are customer advances. This is what in the principles we called unearned revenue. This is where you're paid in advance for something that you are going to deliver, or in other words, you have a commitment to now deliver something, which sounds suspiciously like a liability. You received cash, and now you owe this person or this entity either service or goods or whatever it is that you do. Okay? So in those scenarios, until we actually provide what we have contracted to provide, any money that someone gives us, we either have to give them the service, or we have to give them back the money. So we have to give them something in the future. So typically, those show up in current liabilities for the obvious reason that most people are not going to prepay something more than a year in advance, right? So this should show up in revenue within the operating cycle within the current year. Then we also have refundable deposits, where, again, these typically show up in current liabilities, but if you own an office complex that you're renting out different suites to people, and you have a $10,000 refundable security deposit, you have to pay them that money back if they meet the standards that you set up when they terminate their lease, right? You will owe them that money. Now, if they don't, you have options of what you can do with that deposit, but assuming everything goes as it's supposed to, you will have to pay them back. So again, those are two types of times where someone gives you money, but you are actually, when they give you money, instead of you recording revenue or gain or anything like that, you're recording a liability because they give you money in exchange for something that you have not given them, or they give you money that you're going to have to theoretically give back to them. So this is a situation of a deposit. When you collect a refundable deposit, obviously your cash goes up because you've received cash, but you have a liability now because you have to might have to pay all $300,000 of this back. Okay? You might have to pay $0 of that back. But the fact that it's likely that you'll have to pay that back, and there's a slide that we will look at in a moment here that helps you determine when to record liabilities that you're not for sure will happen. But in this case, for refundable deposits, these should be, by law, refunded enough times that the assumption is that you are going to have to refund this, okay? Even if that's not how it operates in reality. This is not even really looked at as a contingent liability. We just assume we're going to have to pay this back. Now, under the terms of this agreement, there were certain containers that this deposit was paid on, and they were supposed to be back by this certain date. And in this scenario, only 90% were returned. So we need to pay back 90% of the deposit, okay? Because obviously the whole purpose of the deposit is to make sure you're compensated if they don't give you back or if they damage whatever it is they were using. So we needed to have cash on hand for this current liability to pay it back. What would have happened if we didn't have enough cash in the bank here to pay this back? Again, that's why investors care about current liabilities, because if you assume they're not going to get their deposit back, and then all of a sudden they do, and you're like, oh crap, I didn't have the money in the bank. Well, too bad. You got to pay them back, right? So cash flow issues. Remember that as an important reason for tracking current liabilities. In this case, though, we've so far given back 90% of the deposit. So if you looked in our liability account after this journal entry, there would only be 10% or $30,000 balance, credit balance in that account. And now we're saying that that $30,000 is forfeited, okay? Because they let's see, did they never return it or was it damaged? Okay, so we're just assuming in this case that the 1-year threshold for forfeiting the deposit has passed, and now the liability that we showed before flips to revenue. And this may be overcomplicating it a little bit, but, well, I'm not even going to go there. We'll just call this revenue. Okay? You might also see, this is all I'll say about this, depending on the nature of the business and what's going on, this may show up as a gain instead of revenue. If you remember the difference between a gain and a revenue, revenue is when it's a typical normal part of your business that you are expecting to earn money from. And a gain would be when it's just like magically, oh, I stumbled into this by accident based on what I was doing. So in this case, if you're in the business of renting out these containers, and oftentimes they're not returned, and so you just sell them, or if you're in the business of both renting and selling these containers, and one of your rentals turns into a sale, it makes sense to call that revenue. If this is the only time this has ever happened, and it never will again, you may see this show up as a gain. Okay? So in this case, they complicated it a little bit by saying that, okay, well, the fact that this company has a cost of goods sold and an inventory of containers set up this way suggests that they're in the business of both selling and renting. Okay? So when we flip this to a sale instead of a rental, we're basically doing everything that we would normally do with a sale. So the slide that we looked at before here, that's basically the side of a sale where you would normally see debit cash, credit revenue, the side that shows what the customer paid. And then the other component of that is what's tracking what you paid for the item, which shows up in inventory. And when you sell that item, you take it out of inventory, and that amount goes in the cost of goods sold. And then when you compare revenue to cost of goods sold, that gives you your gross profit. Okay? So, again, when this turned into a sale because of the forfeit, we still had this other side of the journal entry to do to be able to track that in our cost of goods sold and remove it from our inventory. Okay? Okay, we already talked about that. Unearned revenue is a liability until whatever it is that we're supposed to give them is paid, whether that is in the form of like a gift card where they can use it to buy anything in the store. Well, until they do that, it's a liability because you have to give them something for that gift card. Okay, anything like that. If someone pays for a subscription to a magazine, you have to provide them with whatever magazines come in the future. If someone prepays for, I don't really hear of this, but prepays for like cable TV or something, you have to provide them the services for that into the future. So these are all handled the same way. When the cash is collected, you have either deferred or unearned revenue. Okay? Either way you call that, calling it deferred versus unearned is it's kind of splitting hairs. They both mean the same thing. These are both liabilities because you have to actually provide them with the service. Then once you do provide them with the service, you can recognize it as revenue. Okay? So you would take it out of either deferred revenue or unearned revenue, which was the liability, and it would go into an account that is an earned revenue account. So it would go from showing up as a liability on the balance sheet to showing up as revenue on your income statement. Same thing with gift cards. Only wrinkle with a gift card is this concept of breakage. On breakage just means after a certain time has passed, they think it's very unlikely that you're going to use the gift card. So at least I know this to be anecdotally true for myself. If I don't use a gift card like for Christmas or my birthday or something someone sent me within like a week, chances are it's lost. My kids have done something with it. They are playing as a credit card with it or some trash or whatever. It's never getting used. Well, apparently I'm not alone. I may be one of the quicker people to go to on breakage. But basically each industry will have, and maybe even each company will have their own time period where they'll say, based on past performance, after 6 months, the likelihood of anyone redeeming a gift card is 0.1%. Okay, so it makes sense then at that point to say, you no longer are recognizing this as a liability because it's unlikely to happen. They gave you money already. Now, instead of a liability, it would then flip to being earned revenue because you don't have to, basically the liability side just disappears. So when you sell gift cards, again, same thing as before. You have an unearned revenue or deferred revenue account. You recognize the cash. If they redeem the gift cards, that's how you would track the revenue side of that. But then remember, whatever they use the gift cards to buy, any inventory that you have, that component still exists. So you would still be, when they made purchases with the gift cards, you would still have the journal entry that showed inventory going down and cost of goods sold going up as well. Excuse me. And then once we hit whatever that magical time period is, where we can call these gift cards, or we can say that they're expired, or the breakage has occurred, then all we do is change the liability to revenue. Okay? Liability to revenue. So same journal entry as if they redeemed the gift cards. Only difference is, with this one, you don't have that other side. No inventory has gone down, cost of goods sold hasn't gone up, so it's basically free money. So you can see why this component here provides a great incentive for companies to try to sell you gift cards, right? Because they know that there's a likelihood, whatever percentage is common in their industry, that they're going to get free money for that. You gave them money, they gave you nothing in return. Sounds like a great deal. So contingency we've talked about already. Just means you're not sure whether something's going to happen. GAAP has these definitions for, and I'm going through this fast on purpose because there's a slide here that is really the only one you need to look at. Okay. Well, I guess the previous slide defines what those things are, so you might want to take a look at what the definition of probable, reasonably probable, remote are. And then with those definitions in mind, you can come over to this slide, and any situation that you're given, if you refer to this slide, you should know whether or not to disclose it. So you just meet at whatever characteristic describes your situation, and if no disclosure is required, you just don't do anything, right? Disclosure note only would mean just in the notes to the financial statements, you have a little asterisk or a little section that says, hey, it's reasonably possible that this known dollar amount liability will happen in the future. It doesn't show up on any of the statements themselves, so it's on the investor, the potential investor, to nitpick through the notes and say, okay, well, if that does occur, will that change my opinion on whether I want to invest in this company or not? Okay. When you do have to accrue as a liability, that's the format for it, for the journal entry. And then when this loss contingency is resolved using a non-cash asset, you would just have whatever the name of that asset account was. If you were using cash to resolve that, obviously, instead of asset, that would be the cash account. You know, I don't want to, I'm kind of losing my voice here. So I've posted all these slides. Take a look at the product warranty stuff. If you have questions, let me know. That's not tested very heavily in the quiz this week. Let's see, what were we doing? Oh, well, I'll just do it this way. Thursday, I'll pick up with this last section on product warranties, and then the remainder of class, I'll just go over the example questions for this chapter. I was thinking about covering another chapter since I was pushing last week to this week, but instead I think we'll just get this one more thoroughly. Okay? Do you have any questions? All right. I'll see you all on Thursday.